Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. My name is Jeff Costello. Welcome to the Wealth Roadmap podcast with Jeff and Steve. Steve does not have an icebreaker ready for us, so it's pretty disappointing, but we're going to get right into it. Today, we are going to talk about mutual fund phantom gains. Now, this is really mostly applicable when it comes to money that's held in non-retirement accounts, so non-qualified dollars. Again, like we've talked about in past episodes, money that is held in a retirement account, whatever goes on in that retirement account, you're not taxed on it until you actually start to pull money out, depending on what kind of account it is. So again, we're going to go over today mutual fund phantom gains. Steve, anything top of mind?
Hey, Jeff. Hey, everybody. Nothing top of mind just yet. Failed on the icebreaker, I guess. Clearly you did too, because you don't seem to have any. Drinking your espresso, I figured you'd have something ready. But no, I think that we should get right into it, because this is a good one, especially when it comes to paying unnecessary taxes or avoidable taxes. As we always talk about, there are avoidable and unavoidable taxes in the tax code. So let's do it.
Cool. So let's dive in. So real quick, Steve, what is a mutual fund? Tell the audience, for those of them that might not.
What is it?
In the basic terms.
Yes, and many of you, many of you, I'm sure do know. Essentially, a mutual fund, it's a way to grow your wealth over time with minimizing risk, because a mutual fund has the ability. You have the ability to be able to, purchase a share or ownership in this mutual fund and get instant diversification, and use investment strategies using a variety of assets, stocks, bonds, other securities. And what it does, especially when you're dealing with, and again, what we're like you mentioned earlier, Jeff, what we're talking about really is when using mutual funds inside of a non-retirement account, right? Again, it's great for instant diversification, but it could be really extremely tax inefficient. And the reason is because of these phantom gains. So, Jeff, if you want to get into the phantom gains, or I can either or, but I don't want to steal the spotlight from you totally. So, tell me a little bit about those phantom gains.
Yeah, I think this is, especially when it comes to mutual funds in general, like you mentioned, Steve, they're a great way to get diversified, with your, with $1, right? The money you put in, boom, now you have a diversification amongst whatever that mutual fund's objective is, whether it's, large cap equity, growth, whether it's a target date fund, or whatever it might be. At the end of the day, you're diversified. And that's good depending on how much money you have, right? Because depending on how much a stock costs, maybe you can't buy it. But what we see a lot is a lot of times people will start off with mutual funds and they just stay in them. And a lot of times we'll see people with millions of dollars that are still in mutual funds when in fact they could really create their own mutual fund by just diversifying amongst stocks, ETFs, things like that, getting the same diversification but being in a more favorable tax position. So let's dive into it. So for mutual funds, again, Steve, talk to me. All right, so I decide, hey, I'm going to start investing my money. Let's pretend I have $100,000 in a mutual fund. What is phantom gains? How does that exactly all work?
Yep. So you have the money, right? Let's say, again, we're talking about a non-retirement account, because these are accounts that you get taxed on, the growth each and every year, depending on what that growth is made up of. So you have $100,000, let's say, as an example. You invest in a mutual fund. Okay, great. Boom. You've invested in a mutual fund. Popular choice for investors to be able to grow wealth. You take advantage of diversification. You get professional management, right? Mutual funds pool investors' money into investment strategies. Okay. So what happens now is, with the fund manager, if they successfully buy low and then they sell high within that fund, capital gains can be generated. And then these gains are distributed to investors, right? To the shareholders of the investors in that fund. And because as an investor, it's a mutual, you have mutual ownership, capital gains distributions get dispersed to the shareholders of that fund. And so phantom gains, right, or phantom income tax, otherwise known as, it's when you're in a situation where you purchased a mutual fund and you're taxed on the capital gains distributions. Because, again, even though if you hold the fund and you hold that fund, and even though you haven't sold any shares of that fund, at the end of the year, I should say kind of January, February of the year, you may, and for those of you who have mutual funds, you've probably seen this, you get a 1099. So let me give an example. Jeff, do we have time for a quick example here?
Got all the time in the world, Steve. Lay it on us.
Maybe you do, but our listeners don't have it. So let's get through it quickly here. So I'm an investor. I decide to purchase mutual fund A. All right. Now, mutual fund A, let's just say, has a holding, has Amazon as a holding, and it's 2022 or it's 2023 or 2024, whenever it is. Let's say it's current 2024. I purchased that fund, and I decided, okay, I'm buying it for the long term, so I buy and hold. All right. Well, here's the thing. Somewhere along the time after I buy that or buy shares of the fund, the manager of mutual fund A or the team of managers, again, it's a professionally managed account, decide to say, you know what, we have a holding of Amazon. Amazon's done extremely well, right? And they've held this position, and they have positions since early 2000s. So it's a heck of an investment. Now, again, I want to point out, I just purchased shares of this fund. I just invested in this fund. But because the manager decides that, hey, you know what, they want to sell positions, they feel for whatever reason, Amazon, there's a better opportunity, and they want to diversify out of Amazon, so they sell. Well, what happens? Okay. The capital gains that they have, so all that growth since 2000, and I'm giving a high-level example just to how phantom gains work. All that growth, now they have to pay capital gains tax on that. Well, as a result, then they are going to pass those capital gains taxes, the capital gains onto, or distribute those capital gains to the shareholders of the fund. So come back to me. I just purchased the fund. Great. Even though I didn't really partake in any of that growth from early 2000s up to 2024, I'm still on the hook for those gains. So I'll end up having to pay taxes on the gains. I get a 1099 on those gains. And as you can see, I still hold the fund. I still haven't sold anything, but I still get a 1099, in January, February of the year after, let's say in 2025, a 1099 with those capital gains distributions. And that's how capital gain can turn into kind of income tax through this phantom gain.
And I think, what
makes sense?
Really, it does. And what rubs, I think, salt in the wound is, so obviously, Steve, right now, as we're recording this podcast, the markets are, back, at the all-time highs and things like that, or at least near it. But talk to me if this was, let's say, a year and a half, 2 years ago, where, again, you buy it at that time. And, when you buy into a mutual fund, right, depending on the mutual fund, you can buy, fractional, you could put in $100,000, for example, right? It doesn't have to, you're not buying equal shares. So, if that share price, let's say, of this mutual fund that you purchased at that time was $100, but then again, the market crashes, right? Talk to us about how that works for the mutual fund and still receiving those phantom or capital gains.
Yeah, no, good point. So all right, I gave that example. All right, well, let's think of a recent period in time, depending on when you're listening to this podcast, but 2022. Okay, let's say same fact pattern. In January let's just say in January 2022, I purchased mutual fund A. Great. I invest that again in a non-retirement account. What happens in March, April of 2022? Market downturn, right? Rampant inflation, war, geopolitical risks, fears of recession. on and on. The market goes down. Now, granted, I purchased this fund in January, all right, but now all of a sudden March, April hits. March, April, May, continue on throughout 2022, and what's happening? The market is just spiraling. Now, as an investor, I've always been taught, you know what? It's for the long term. I understand markets come back, as I'm sure many of our listeners understand that, and they wouldn't make rash decisions. Well, but here's the thing. Other people get spooked. Other people maybe didn't purchase that fund with a long time horizon in mind for whatever reason. And so as a result, what do? Well, they have bought whenever they bought shares of that fund, and now they're panicking. So they either call up their broker or their advisor or, the fund company, whomever, and they say, I want out. Markets are going down. I need the money. Sell, just get me out of here. So what do the fund managers have to do? Well, they have to sell positions in order to raise cash to distribute that money to the person who is requesting that sale, that distribution. Okay, so again, come back to me. I haven't sold. I'm not too happy of where my value is towards the end of the year, but I say it's okay. It's for the long term. Let's say that fund is down 15% towards the end of the year. The year is over now. Now I'm still down because remember, I bought it in January when markets were high, and now I've lost roughly 15%. Again, just trying to give you an example, illustrative purposes only. That drop of 15% is on paper. I didn't sell, and I understand that I just got to hold. I just got to give it time, and over time, my account will grow based on historical performance. Well, 2022 is over, and now it's January or February of 2023. So what do I get in the mail? Well, I get a letter, more or less, from the mutual fund company in the form of a 1099 that says, basically, hey, Steve, and this is kind of, I'm making a joke, a little bit of this. It doesn't really say this, but it says, hey, Steve, we know you didn't sell, but because other people, other owners or other shareholders in the fund sold and requested a distribution, as a result, we had to sell positions. And because we sold positions, well, we now have capital gains due. And because we have capital gains due, and because of how a mutual fund operates, we have to spread those capital gains distributions across mutual fund shareholders. And so now I have a 1099, and I have to pay tax on that, on that capital gains distribution that they distributed to me. So let's recap that for a second. Not only did I not sell, but I also have a loss in my account. So I didn't sell, I have a loss, but I also now have a tax liability. I have this 1099 that I have to pay tax. Now this 1099, depending on other forms of income that I have, is going to determine the amount of tax that I have to pay. So you can see there that, year in and year out, when you hold these mutual funds in non-retirement accounts, brokerage accounts, that the phantom gain can really start to eat into the return. And depending on the taxes that you have to pay, where your tax rate is, can really ultimately determine what that true after tax rate of return is, which could be less than what you think that return is going to be, right?
Yeah, I think that's a great example. The other thing that we haven't really mentioned is, whether even if your account was up and you're getting this 1099, maybe it's easier for you to swallow. But, the thing is that the fund managers are the ones that really control what's going to happen, right? From a tax liability standpoint. Whereas if you owned all of the same stocks in your own account that this mutual fund owes, you're only going to be paying taxes when you decide to sell. So it also makes it, tax planning or tax management a little bit more tricky, right? Because you don't know what that fund manager is going to do throughout the year that might create that tax liability. And we've seen in, past podcast episodes that we've talked about how just the smallest little trickle-down effect from taxes can then cause, Medicare Part B premiums to go up, or for Social Security all of a sudden to be taxed, and things like that. So, not only do you run the risk of running into this phantom gains with mutual funds with, again, non-retirement dollars, but you also lose out on the control from a tax exposure standpoint.
Great point. And this is why, we believe that tax management should be incorporated to any investment or financial retirement planning decision that you make, because if you make an investment decision in a vacuum, you could be significant. There could be better options or better ways to optimize that after tax or that take home value that you get, right? Because let's face it, we understand taxes are going to be there and we have to pay them. And different investments and different types of accounts are taxed differently. Simple as that. So managing and monitoring your tax brackets each and every year, along with the investments that you hold, and properly structure those investments to minimize those taxes and be able to, or reduce those taxes, right? And be able to grow and increase that overall take home pay, or I should say take home wealth.
So Steve, what
the other thing too,
go ahead.
Yeah, no, I was just gonna say, just kind of from that standpoint, kind of just if you choose the right type of investment, because there are different investments, and Jeff, I don't know if you're going to go into this, but you have to understand that depending on kind of, a mutual fund is one type, an ETF is another type, and so there are different options to utilize in order to be a little more tax efficient, right? So again, we're not saying kind of you have to pick your own stocks, right? And because a lot of times, and we recommend being able to take advantage of, professionally managed type of account with diversification within it is important, because we don't want to be dealing with stock picking, or I shouldn't say that. Some people may, but other people don't. So yeah, Jeff, and if you could jump in, right? There are other options besides, it's like, well, if I can't do a mutual fund, then I just have to pick stocks. Well, no, you could do other things, right, Jeff?
Yeah, and so there's obviously pros and cons with looking at, like ETFs. There's, tax sensitive, ETFs or tax sensitive, portfolios out there that you can look into. My question to you, Steve, was going to be, all right, well, if someone's listening to this podcast and they're like, holy cow, yeah, I have $100,000 in a mutual fund, I have $1 million in a mutual fund, whatever the number is, and they want to make they want to kind of rip off the Band-Aid and put themselves in a better position going forward when it comes to taxes, what should they be doing?
That's a great question. So it really depends, because it's a challenge. So we first have to understand other assets that you have, other income that you have, because depending on how and when you rip that Band-Aid off, right, you can generate capital gains taxes, and you can kind of push yourself into higher tax brackets and so forth and so on. So I think the first thing to determine really, and whether that's with you, whether that's talking with a professional, or whether that's reaching out, it's what we do with our clients and with the people that we work with, is putting together a tax transition to be able to have a proper tax management strategy, right? But the tax transition is to map out a plan to be able to, whether it's resetting the cost basis, or whether it's strategically over time kind of moving some low basis positions, or selling some low basis positions, depending on market conditions, depending on your personal situation, where you are in life, what stage of that money cycle are you in, the accumulation, the preservation, the distribution phase, because every phase is going to require a different set of strategies as well. You have to understand that. And I'm not trying to beat around the bush here. It's just there's a lot of things that go into it, right, Jeff? And a lot of times it's first understanding, and it's the mindset of understanding, okay, it's either I'm paying tax now or I'm paying tax later. And a lot of times it's hard for people to even rip that Band-Aid off or get over that hurdle, because paying that tax now is like there's an extra expense. Well, here's the thing. Well, what happens if the tax code changes? Okay, and potentially taxes increase, or what happens if the growth continues, or you continue to get growth? You're just going to have to pay more tax later on. What happens if you have other income coming in? If you're in retirement, and you need to end up selling, and you're forced to do it, right? Instead of maybe being proactive and putting a plan together. Now, if you're forced to do something and you have to sell, you're going to recognize more taxes. So I think it's really, everyone's situation is different, but I think it's really one of those things where it's something that if it's you feel like it's important or not even important to execute, but important to review, either do it yourself if you feel comfortable or reach out to somebody. I think another set of eyes sometimes can do really great things, or at least give you a better perspective.
Yeah, I mean, it's I think it's obviously it's stuff like that. Ripping off the Band-Aid is always something that taxes stink, but at the end of the day, you just want to do that analysis and see if it's going to benefit you in the long run, and if it's worth it or not. I think this is pretty much a really good segue, I think, into another episode in the future on tax loss harvesting, on how if someone did want to transition their mutual funds maybe into another investment, how they can do so in a tax efficient manner, in a obviously again a smart precise way, as opposed to just pulling it all out and hoping for the best. But I think again, so if you're listening to this podcast, and again you have money that's again non-retirement dollars in a mutual fund, this is a good time to speak with a financial professional, financial advisor, and see if there's anything better that you can be doing. Again, same diversification, but maybe something that's a little bit more tax efficient, because you don't want to be throwing money away to Uncle Sam. And if you do, then this podcast is not for you, because this is the Wealth Roadmap. So, Steve, any last words on phantom gains before we let the people go?
No, I guess the last thing is, I think we mentioned, just explore. You could always explore alternative options, right? ETFs. You could pick stocks, but no, I think we covered it. I think it's a great point. It kind of leads us into another future episode that we could dive deeper into. And if there's questions, please don't hesitate to reach out. wealthroadmaps.com. Feel free to ask any questions from that website. So there we are.
And so just for quick clarity, it's wealthroadmappodcast.com. But Steve knew that. He was just testing me. Everybody, enjoy the rest of your day.
Well done.
Be sure to subscribe, share this with a friend, and we'll see you on the next podcast. Take it easy. Thank you for joining us. If you enjoyed our podcast, don't forget to like, subscribe, and leave a comment on topics you'd like for us to cover on future episodes. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using contact information herein. Please read the disclosure statement carefully before you invest or send money.